Karen Nash, nice to meet you again.
Lovely to see you again.
How are the Mighty Roosters going?
Honestly, not doing too well. Got knocked out last night.
Look, there's always next year. You have a pretty good squad though, don't you?
We can hope.
Oh, there we are. Hey, look, so I understand Asha can't be here today. She's attending to family matters. But how about we book a meeting for you two together next week?
Yeah, that sounds perfect.
Perfect. Awesome. I know that you don't have much time today, so how about we get straight into it?
Yeah.
Done. Okay. So when we first met, you were a bit unsure about your financial situation, and you had some goals you wanted to achieve, and you believed that you weren't on track. So, just your goals summarised is that you wanted to obtain appropriate insurance. So basically, in the event of your death, your total and permanent disability, or if you're unable to work for a period of time, you wanted to be appropriately covered and your funding would be sufficient if any of those events occur. You also wanted to ensure that your superannuation was invested appropriately and you were building funds for retirement in the most efficient manner. So other things that you liked, where you wanted low cost investments, and you didn't want to be thrown into a default fund. So we've made a little investment strategy for you there. You also stated that you didn't like your mortgage and you wanted to pay it off as soon as possible, basically. So what we've done is we've implemented a debt management strategy there. So let's get into the first strategy, insurance. Can be annoying, but extremely necessary. So basically, we've recommended life, TPD, and income protection insurance. For your life and TPD insurance, we recommend that you hold it inside super so that it doesn't affect your personal cash flow. But with your income protection, we'll hold it outside super so that when, in the event that you're unable to work, you can get paid directly to you. I know that it may put extra burden on your cash flow, but we determined that it was appropriate for you. And you've also got the benefit of your premiums being tax deductible, so win-win. So when calculating how much cover you need, we do this thing called a needs analysis. So for life and TPD, when we calculate it, what we want to do is, in the event of your death, we want to extinguish your debt. So your mortgage, we don't want to leave that to ASHA or any of your loved ones. We also want to ensure that you've got final expenses covered, maybe such as legal fees that you may need upon your death, fees that may come upon administering your estate, or fees, other fees like that, your funeral expenses. For total and permanent disability, it's quite similar with a few tweaks. So basically, we want to extinguish your debt again, because once again, if you're totally and permanently disabled, you don't want that liability. You also want money just to fund for Ash to be a carer if she wanted to be a carer, or outsource another carer. You also want ongoing income requirements for yourself, and you'd also want things for like car and home modification, because if you're in a wheelchair or anything like that, you wouldn't want to be, going upstairs would definitely be hard, and travelling would be hard. You need more space in the car, you need wheelchair accessibility. So this is the amount of cover we've recommended to you. It's about 1.1 mil, but that's the exact cover there. What we've done here is we've linked the life and TPD cover together. So basically, they're one policy. The con of that is that if you were to become totally and permanently disabled, your life cover would become void. But to combat that, we've added the life buyback option. So if you were to become totally and permanently disabled, you could buy back the life cover without going through any of the insurance processes or anything like that, which is a big plus. But also, linking them together implements quite big cost savings, and that was quite appropriate for you, especially since you're holding them inside super. It'll help your super balance greatly. So, for income protection, we calculated that as your max benefit. So your max benefit is 75% of your yearly salary, and then you divide that by 12 to get your monthly benefit, because that's how it's paid out. So what we've done here is we've calculated that, and that's how much you get each month, right there. Another two important factors to consider as well is your waiting period and your benefit period. So your waiting period is basically how long you have to wait to get your first payment. So we've put 30 days. You've got sick leave to cover that 30 days, and then it'll get you paid out pretty quickly as well. And the benefit period is to age 65. It's one of the best benefit periods out there. So pretty much you can get paid out until you turn 65. So just quickly, to ensure that you have some understanding of what we're doing for you. Can you explain that to me?
Yeah, of course. So with life insurance, you're saying if something was to ever happen and I was to pass away, Asher and Josh would receive this lump sum payment to cover their grieving costs, funeral costs, just to get them by. And then obviously if I was to become totally or permanently disabled, we would also receive this lump sum payment that would be to get us by, but to also making modifications to the house, the car, just if I was in a wheelchair or something like that. And then obviously income protection, if I'm unable to work for whatever reason, I will get this amount here every month until I turn 65, and the only catch is that I've got a waiting period of 60 days. 30 days.
Yeah, that's absolutely perfect. Awesome. So we'll move on. Specifically for life and TBD, we recommend you with BT Insurance. As you can see there, it's the cheapest monthly premiums available. It's also got a good feature score. So basically, if you were to pass away or become totally and permanently disabled, it'd provide you with all the benefits being paid out. The process of getting paid out is a lot easier. And then income protection, we've done the same sort of thing. You can see once again that it's the cheapest, especially because you're paying for it out of your personal cash flow. We determine this to be such an important factor for you. But yet again, it's still got a great future score.
Mm-hmm.
So if you were unable to work for a period of time, getting paid out would be quite a breeze, which is awesome. So we'll move on to your superannuation now. So at the moment, I understand you have 3 funds, yeah? So you've got Pavarotti, Carreras, and Domingo.
Yeah, correct.
And do you understand how super works? So like you get admin fees and stuff like that?
Yeah, I do.
Yeah, so what we're going to do there is we consolidate it into one fund, which is the recommended A&P MyNorth Super. So what that does is it decreases the fees payable, admin fees, investment fees, and anything like that, because you're only paying fees from one account.
Mm-hmm.
We also determined MyNorth to be one of the cheapest super funds in there. So what I've done is in your SOA, I've tagged this section where it explains the fees for you completely. So you can read that in your own time, but we've already explained it to you anyway, and you've understood it.
Perfect.
Another important factor with this is that you currently hold insurance within your Carrera Super Fund, yeah? So, referring to your previous strategy, we must implement your insurance before we actually roll all your supers into MyNorth. Because what happens here, I understand that you're concerned about being uninsured yet.
Yeah.
Yeah, so what we're going to do is implement your insurance first, and then we'll fill in the forms to roll your super funds. So what that will do is ensure that you are insured, and you have no period where you may not be covered. So we also need you to contact your employer to make sure your super guarantee is paid into your new MyNorth Super Fund, because you don't want to reactivate any of these dormant funds and pay extra fees or anything like that. And this is also your life and TBD insurance premiums that will be coming out.
Yep.
We've accounted for that. So basically, when we conducted our fact find, we did your risk profile. I'm sure you remember that, yeah?
Yeah.
Yeah, so what this takes into account is basically how much risk you can tolerate and you're willing to tolerate, and like your attitude to investments as well. So we calculated you to be an 85% growth investor. So basically what that is 85% of your superannuation money will be invested in growth assets. So they're things such as Australian equities, international equities, and property infrastructure, as you can see over there. And then the defensive assets are things such as cash and fixed interest. So basically the 85% will be in investments that will help your super grow. They are a lot more risky and a lot more volatile, but we'll have 15% in the more stable things such as fixed interest and cash. So just so you understand how you're invested, do you maybe want to explain to me?
Yeah, so essentially as an 85% growth investor, you're saying that 85% of the money in my super account will be invested into more aggressive things that will help my overall net worth grow, so when I have money for retirement.
Yeah, that's right.
And the other 15% will be put in more defensive assets.
Absolutely right. That's perfect. Understood perfectly. So here is your underlying investment strategy. So I know you understand that your superannuation funds are invested, as we just explained, but this is our investment strategy for you. So what it's called is a core satellite investment strategy. What it does is if you think about a core and a satellite, there's one main core there with a few satellites surrounding it. That's exactly what we've done here. So the base of your investment will be in what's called an index fund, a MyNorth index fund. So what that does is it just tracks the market index, yeah. But the thing about that is it's passively invested, so the fees are quite low. There's no manager actively trading stocks or anything like that. So you don't have to pay as much fees, but it's still quite good returns if the market goes well. But what we've also done there is you didn't really want to be in anything quite default. So what we did is we added 4 other actively managed funds, as you can see here. So what that does is they're actively managed funds. Fees are a little bit higher, but because we don't have so much money in it, fees are still quite low. But now you've got the potential for above average growth. So all these funds here that have got a manager, they might actively trade shares and things like that. And you may beat the market index. So we thought that would be quite appropriate for you. You're still young, you could take that risk. But we've also added a cash account, so 5% of your funds will be in a cash account. That'll pay for fees, such as my initial fees, ongoing fees, or insurance premiums and stuff like that. So I know some people find it daunting, but maybe can you explain that back to me?
Yeah, so essentially what you're saying is 50% of my superannuation will track the market. It's not going to go above and beyond, but it will still get steady returns if the market goes well.
Yeah.
And the other 45% are in things that are a bit more aggressive, where we're trying to beat the market and get better returns. And then there's a 5% cash account for all administration fees.
That's absolutely right. Awesome. Moving on. This is just what your super's projected to be at retirement. You wanted to retire at the same time as Asher, at which you'd be age 54. So this takes into account all the contributions going in and the premiums coming out and all the fees. So basically, at the point of retirement, we project you to be just over $1 million, which is quite good. And honestly, compounding interest gets you there. All your contributions help you so much. And what I've done here is I've included a little graph. So when you retire, you stated you want your expenses to be here at this level. So what this is your blue line is your net financial assets. It's basically anything that can be turned into cash or cash to fund your retirement. You want that line to be as high as possible at all times. And here is your projected lifespan, which is about age 88. And you can see that that line is well and truly above in the positive range for it. So when you retire, you get your desired expenses well and truly comfortably. You can even draw more. Lastly today, your debt repayment. Basically, you want to get rid of your mortgage. So what we've done is we agreed that both you and Asher could draw back on lifestyle expenses. So here what we've done is we've drawn back about $6,000 a year and contributed that to your debt repayments. So as you can see here, this is your original strategy, $3,167 per month. And then now your new strategy is $3,600 per month. As you can see, you save about 40 grand in your new strategy, and that's in tax savings. And it's also paid off 3 years sooner, which you have 3 years less to worry about debt, which is fantastic, a lot of peace of mind. Now moving forward, where to from here? We just read all the relevant product disclosure statements, which we've emailed to you. I'm aware that you've gotten them and you've had a read through them already. You need to also make sure that my fees were stated in the SOA, and are you still happy with that?
Yeah, of course.
Awesome. So we also need you to sign the relevant insurance application forms, which we will provide to you. We'll also sign the forms to consolidate your Carreras, Pavarotti and Domingo super funds into your new recommended minor. But that's once your insurance is put in place. So we'll give you all the forms, it should be easy. You've also got to contact your bank yourself to increase your monthly debt repayments. And which is quite important here, is monitor your financial situation and contact us if anything changes. Because if you get like an inheritance or you have another child, this strategy may not be appropriate for you anymore. And lastly, we just need to ensure that you're familiar with your financial services and credit guide that you received at our first meeting. So I know that you've read through that, it was just a reminder here. Awesome. Do you have any concerns or questions?
No, I don't. Thank you very much for that.
Awesome, thank you. I'll see you next week with Asher.
Thank you.
See ya.